Thank you, everybody. Thank you, thank you, thank you. Good morning. Good morning. All right, picking up where we left off yesterday, going over the one big beautiful bill. We are starting on page 25 today. Give people a few minutes to hop over to youtube.com/Kellerman Comedy. That's where you're going to be able to see, what's behind me. Hey, Black Sheep. There he is. My moderator is here. Oh, my chat box isn't working, though. How do I fix that? There we go. Good morning. Good morning, Melinda Baker. Good morning, Black Sheep. Thanks for joining on YouTube. What's up, Viducio? I hope I pronounced that correctly. Let's just move this. Oh, that's not what we want to do. Let's keep the chat. What's up, Sergio? We here. We in here. All right, welcome everybody. Good morning, good morning, good morning. You're on multiple lives at the same time? That's a little excessive. I appreciate the love and support though. You're not a black sheep, you're more like a black goat, cuz you're awesome. All right, where were we? Starting today at the bottom of page 25, section 111103, increased dollar limitations for expensing of certain depreciable business assets. Under the current law, which is IRC section 179, a taxpayer may elect to expense the cost of qualifying property rather than to recover such costs through tax depreciation deductions subject to limitation. Under current law, the maximum amount a taxpayer may expense is $1 million of the cost of qualifying property placed in service for the taxable year. The $1 million amount is reduced by the amount by which the cost of such property placed in service during the taxable year exceeds $2.5 million. So you have to spend $2.5 million to get a maximum of $1 million tax expenses. The $1 million and $2.5 million amounts are adjusted for inflation for taxable years beginning after 2018 and are $1.25 million and $3.13 million in 2025, respectively. In general, qualifying property is defined as depreciable, tangible, personal property, off-the-shelf computer software, and qualified real property that is purchased for use in the active conduct of a trade or business. The new provision increases the maximum amount a taxpayer may expense under IRC section 179 to $2.5 million, reduced by the amount by which the cost of qualifying property exceeds $4 million. The $2.5 million and $4 million amounts are adjusted for inflation for taxable years beginning after 2025. So the proposal applies to property placed in service in taxable years beginning after December 31st, 2024. Now, as I read through these sections, we've been kind of discussing whether or not these are only good for the wealthy, good for everybody, or not good for the wealthy. This one seems only good for the wealthy. I mean, unless you're writing off $1 million worth of expenses, you're not going to get any advantage out of this. At least that's my understanding through my initial reading just now, right here, live in front of all of you. So let me know in the chat if I got it right, and let's check ChatGPT to just check my understanding here. Someone on Instagram just asked, when is it ever good for common people? And the answer is, there have been a number of things in this bill. If you go back and watch some of the previous lives that I did, they're all on YouTube. Some of these things have been good only for the lower class, or lower middle class, you know. All right, so how things work right now is you can instantly deduct up to $1.25 million of stuff you buy for your business in a year. But if you go over $3.13 million in total purchases, the amount you're allowed to deduct gets reduced. So if you're spending more than $3 million, you start losing a little bit of your tax deduction. So if you buy $3.63 million worth of stuff, you're $500,000 over the limit, so your max deduction gets cut by $500,000. The change in 2025 is that the instant write-off limit jumps to $2.5 million. The cutoff for reducing that limit goes up to $4 million, so you can buy more stuff and still get the full tax break. These numbers will go up each year for inflation. So before the change, you could write off up to $1.25 million. After the change, you can write off up to $2.5 million. That means you save more on taxes faster. Now, as I mentioned just a second ago, my understanding of that is that it's only going to help the wealthy. But let's just see if AI thinks that could be beneficial for anyone other than the wealthy. Do you think it only benefits the wealthy? Sounds like it does. No, it doesn't only benefit the wealthy. Who benefits? Small and medium-sized businesses benefit a lot, especially those that need to buy expensive equipment to operate, like farms, restaurants, factories, construction companies. The new higher limits just let them write off more of those costs faster instead of waiting years to deduct bit by bit. So, wealthy businesses like big corporations can benefit too, but there is a phase out over $4 million. So like the really big businesses that are spending multiple millions of dollars are actually getting less of a benefit than the smaller businesses who spend around $1 to $2 million. So huge companies will hit the brake, and regular sized, medium sized businesses will benefit more from that. So a small bakery buying new ovens and display cases will get a big help from this. A construction company buying bulldozers and trucks, big help. Amazon buying 10 warehouses, not really affected. They're too big to fully benefit from this specific rule. So the bottom line is, it helps businesses reinvest in themselves more quickly, and it doesn't only help the wealthy. In fact, it's designed with smaller businesses in mind. Okay, so far so good. First provision. Someone in my chat just said, I understand now why you have no followers. You have to pay more attention to your audience. I'm literally live right now talking to my audience, and I don't have no followers. I have millions of followers. That's the other reason why I'm doing this. You guys are crazy sometimes. Anyways, I think people sometimes just say things to say things. Okay, moving on. Section 111104, repeal of revision to de minimis rules for third-party network transactions. So under the current law, third-party settlement organizations issue Form 1099-K to participating payees receiving gross payments exceeding $600 for goods or services, regardless of the number of transactions. A third-party settlement organization is the central organization that has the contractual obligation to make payments to participating payees, generally a merchant or business, in a third-party payment network. The change in reporting thresholds was supposed to take effect following the American Rescue Plan of 2021. However, due to delays in implementation for the 2024 tax year, third-party settlement organizations must issue a Form 1099-K for payees receiving gross payments exceeding $5,000 for goods or services, regardless of the number of transactions. This threshold decreases to $2,500 for 2025 and is set to drop to $600 for 2026 and beyond. As originally mandated by ARPA, though the IRS has repeatedly delayed full implementation. So this provision modifies requirements for third-party settlement organizations to eliminate the reporting requirements with respect to the transactions of their participating payees unless they have earned more than $20,000 on more than 200 separate transactions in applicable tax period. This reverses the ARPA provision that lowered the reporting threshold to $600 with no minimum on the number of transactions. So again, right off the bat, that sounds like it will benefit small and medium-sized businesses more, or maybe it just is good for all businesses. What do you guys think? Does that sound good for everybody? We can ask AI, but so right now, when you get paid through apps like Venmo, PayPal, Cash App, Etsy, eBay, or other online platforms, the IRS wants to know if you're making money from business stuff, like selling goods or services. These apps send you a tax form called a 1099-K. Obviously. I got a 1099-K for the $30 I made off Instagram last year. What the law was supposed to do, according to the 2021 American Rescue Plan, is anyone who made over $600 in business income, even on just one sale, would get a 1099-K. But this made a lot of people freak out, especially folks selling stuff, splitting dinner bills, doing side hustles occasionally, because they're taking payments. You know, when you split a bill with somebody, everybody Venmos the person, right? So if you get over $600 worth of Venmo payments in a year, then you have to report that and have taxes taken out. So the IRS kept delaying it, right? In 2023, still 20,200 transactions. In 2024, lowered to $5,000. In 2025, it was supposed to drop to $2,500. And in 2026, finally hit $600 unless something changes again. This new provision cancels all that. You only get a 1099-K if you made more than $20,000 and had more than 200 sales. So that means that if you have one sale for $20,000, no taxes. Both conditions have to be met. The old rule is 1099-K if you made 20K plus on 200 plus sales, which was going to change to $600 on even one sale. And the new proposal goes back to the old 20,200 transactions rule. So who benefits from this change is casual sellers, Venmo, eBay, Etsy. Those are the most likely beneficiaries of this. People selling used stuff, splitting bills, or doing one-time gigs. People making real side hustle or small business income may still need to report it, but they won't automatically get a 1099-K unless they're making over $20,000 in transactions. So this, I'm going to just check my understanding here, but it sounds like that's more beneficial for smaller businesses. Is this more beneficial for small businesses or large businesses? More beneficial to casual sellers and side hustlers. Not most small or large businesses. Here's a breakdown. So, individual people and very small sellers who sell on platforms like eBay, Etsy, Facebook Marketplace, Venmo, etc. These are often hobbyists, people selling used stuff, or folks doing a few gigs per year. They may now avoid getting a 1099-K, which means less paperwork and less chance for confusion to the IRS audits, blah, 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 blah. Some very small businesses will benefit, like a person selling handmade crafts or doing a few $100s of freelance work a year, but most real small businesses, even just one-person shops, will still report their income anyway because they want to stay legal, they usually make more than $600, and many already track income themselves even without 1099s, right? So this is going to really impact non-business owners who were going to have to pay taxes on things like Venmo payments if they made over a certain amount. But, you know, large businesses straight up unaffected. They already get 1099-Ks. They already report all the income. This doesn't change anything for them. Love that. So casual sellers, big... ChatGPT is getting better at breaking things down, I think. Casual sellers is a big yes. Less paperwork, fewer forms, less IRS risk. Tiny side hustles avoids 1099-K unless they really grow. Small businesses, maybe a slight benefit, but not really. And large businesses, no benefit at all. Love that. We love that. Okay. Section 11 1105, increase in threshold for requiring information reporting with respect to certain payees. Under the current law, the reporting threshold for payments by a business for services performed by an independent contractor or subcontractor and for certain other payments is generally $600. In some cases, the reporting threshold is based on payments made during the taxable year. This provision generally increases the threshold to $2,000 and adjusts it for inflation for taxable year beginning after 2024. The new threshold is based on payments during the calendar year. This provision applies to payments made after December 31st, 2024. So it seems like the reporting threshold is being increased. If you make less than $2,000, you don't really have to report anything at all. We're just going to check my understanding to make sure I'm not lying to you or getting something wrong here, misunderstanding. It's always possible. Always a possibility. You never want to assume you're smart or correct. If a business pays a freelancer, contractor, or subcontractor, like a plumber, designer, or gig worker, the business usually has to report that payment to the IRS using Form 1099 NEC. This helps the IRS know who made money and make sure the taxes get paid. Under the current rule, if a business pays someone $600 or more for work in a year, they have to send that person a 1099 form. That $600 can come from just one payment or several small payments. The person who got paid then uses the 1099 to file taxes. What's changing is the threshold is going up from $600 to $2,000. So if you made $1,500 off of a sale or something, you don't have to pay taxes on that. So now the business doesn't have to send a 1099 unless they pay more than $2,000 in the total calendar year. This new rule starts now, and in 2025 if the bill is passed. And the $2,000 limit will go up with inflation over time. Great. We love that. Who benefits is small businesses and side hustlers, freelancers. Not big business. Not big business. And I only keep pointing that out because I see a lot of news reports talking about the one big beautiful bill and talking about how it only benefits the wealthy. So far, if you've been watching these lives, that's not really accurate. That's not really accurate. Moving on. Section 111106, repeal of excise tax on indoor tanning services. Why are we passing laws specifically for tanning services? I don't know. Under the current law, there is a 10% excise. Do you guys tan? Do you guys go pay for tanning booths and things? Under the current law, there is a 10% excise tax on amounts paid for indoor tanning services. Indoor tanning services include any service employing any electronic product designed to incorporate one or more ultraviolet lamps intended for irradiation of an individual by ultraviolet radiation to induce skin tanning. They really had to spell out what a tanning salon is there. The provision repeals the excise tax on indoor tanning services effective on the date enacted. Is this really? I'm gonna put it into ChatGPT and then I'm gonna ask it what other businesses might use those lamps other than a tanning salon. So if you go to a tanning salon and use a tanning bed, you're actually paying an extra 10% tax on top of the cost just because it's indoor tanning. That's called an excise tax, which is basically a special tax on certain stuff like cigarettes, alcohol, and tanning beds, which I didn't even know there was a tax on tanning beds. The current rule is you pay 10% extra when you use indoor tanning services. This tax was originally added to help fund health care from the Affordable Care Act. They started taxing tanning booths to boost healthcare costs? Okay. What's changing? The 10% tax is being repealed, gone, erased, wiped out. So once the law is signed, you will not have to pay that extra 10% anymore. So tanning bed costs go down. What? Why is this part of the one big beautiful bill? I don't even think Trump uses tanning salons. I'm pretty sure that's a spray tan. I'm just guessing. I'm really just guessing. I really don't know. I don't think you get that nice natural orange from a tanning salon. Let me just take a look at. I'm going to take a little break to check out the comments here. What are people saying? How are people feeling about all this? Do we figure out about the 1,000 page or what you're reading from? Yes. Yes, Sarah, I did. So what I'm reading is the brief. It's the 50-page version of the 1,000-page document, and it has all of the supposedly most important stuff. Obviously, it would take me who knows how many lives to read a full 1,000-page document, and by the time I finish that, it'll be past or dead or whatever. So I'm not going to read through the full 1,000-page document the way we're doing this 50-page document, but when I'm done reading this 50-page document in the last episode, in the last live that I do regarding all of this, I am going to compare and contrast the 1,000-page document with the 50-page document and see if there's anything missing, overlooked, not mentioned, etc. So we will get to the 1,000-page version, but I'm not going to read through it the way I'm going through line by line on this 50-page version. I can go fry myself now. Yeah, go get a tan, guys. Well, wait till the bill passes. Otherwise, you're going to pay an extra 10%. What a ridiculous thing to have in this bill. This is fucking silly. All right, section 111107. Exclusion of interest on loans secured by rural or agricultural real property. Current law does not exist. This provision allows for a partial exclusion of interest on certain loans secured by rural or agricultural real estate. Specifically, it allows for the exclusion of 25% of interest received by a qualified lender on any qualified real estate loan. If I understand that part correctly, it sounds like this is a tax break for the people who give the loans. A qualified lender means one, any bank or savings association. Excuse me, it's still early. Any bank or savings association, the deposits of which are insured under the Federal Deposit Insurance Act, any state or federally regulated insurance company, certain U.S. bank subsidiaries, certain U.S. insurance subsidiaries, and with respect to certain loans, any federal chartered instrumentality of the U.S. established under Section 8.1A of the Farm Credit Act of 1971. A qualified real estate loan means any loan that meets the following requirements, which is 1, the loan is secured by rural or agricultural real estate or by a... Can you guys say rural 5 times fast? Just try it. Take a moment and try to say rural 5 times fast. The loan is not made to certain foreign entities of concern. And 3, the loan is made after the date enactment and before January 1st, 2029. Rural or agricultural real estate means 1, any real property which is substantially used for the production of one or more agricultural products, farms. Any real property which is substantially used in the trade or business of fishing or seafood processing, or certain aquaculture facilities. This term does not include any properties not located in the U.S., so this is only for the U.S. What? What does that do? Anybody get that one? I'm from Baltimore. I can't say anything right. How do people in Baltimore say rural? Can you spell it out phonetically for me? Is it rural? Rural? I tried rural and now I can't say it at all. Yeah, I feel like the word has lost its meaning. I've said it so many times in the last live. And rural? Rural? That's too much. You guys are funny. All right. If a qualified lender gives someone a loan to buy or improve rural or agricultural property, the lender can exclude 25% of the interest they earn from taxes. So if they make $1,000 in interest on one of these loans, they only have to pay tax on $750, not the full amount. So this is a tax break for lenders. So if a bank gives $500,000, it gives a $500,000 loan to a shrimp farm in Louisiana, the bank earns $50,000 interest over time. Under this rule, the bank only pays on $37,000 of that because 25% is tax-free. This sounds like it only benefits the wealthy. I gotta be honest. This sounds like a big tax break for banks. Does this only benefit the wealthy? You know, people who believe in trickle-down economics would think that if the lender has to pay less taxes, then their fees and things will go down. But let's be honest, it doesn't really work that way. ChatGPT, on the other hand, says, no, this does not only benefit the wealthy, though some wealthier institutions and landowners may get more value from it. Who it helps is lenders, banks, insurance companies, farm credit system lenders. They get a tax break on the interest. This makes lending to farmers, fishers, and rural businesses more attractive. Okay. Borrowers, like farmers and rural business owners, the idea is that if the lenders save on taxes, they might offer better interest rates. Just like I said, this is purely based on trickle-down economics. This could help small farmers, aquaculture operations, or fishing businesses that often struggle to get affordable credit. So banks might be more likely, because of this credit, to give smaller businesses larger loans. But truthfully, I don't know if it'll do that. You know, they might just keep doing the same number of loans and pay less taxes on it. Right? No way to know. No way to know how if that will trickle down, but typically it doesn't. Yeah, do anybody in my chat believe in trickle-down economics? Anybody think that works or even exists, really? Section 111108, treatment of certain qualified sound recording productions. Under current law, under IRC Section 168K, taxpayers are generally permitted to expense a percentage of qualified property in the taxable year that the property is placed in service. Additionally, under IRC Section 181, taxpayers are permitted to expense a certain cost of film, television, and live theatrical productions in the taxable year such costs are incurred. In the case of productions commencing before January 2026. Guys, this impacts me. This is what I do. I buy a bunch of filmmaking and audio equipment. So this provision will increase taxpayers' ability to expense certain costs of producing sound recordings. Specifically, it would make qualified sound recording productions placed in service before January 1st, 2029, eligible for expensing under IRC Section 168K. It would also allow taxpayers to expense up to $150,000 per taxable year of costs of qualified sound recording productions under IRC Section 181. A qualified sound recording production is a sound recording produced and recorded in the United States. Again, kind of like the tanning bed. Why is this included? Why is this part of the bill? So the government already gives tax breaks to people who make movies, TV shows, and plays. I work in the film and television industry, letting them deduct those production costs right away instead of spreading the cost over many years. With the current rule, if you make film, TV show, or play, you can expense the costs in the same year that you spend the money. This helps producers lower their taxes and recover their money faster, but this only applies to productions that start before 2026. I'm the producer of my show, guys. Love this. What's changing now, music producers, I guess this probably won't really affect me since most of what I buy is like film production equipment, but you know, I buy microphones and things like that occasionally. Music producers who create sound recordings and get the same benefit. So I guess that used to exclude music producers. They can deduct up to $150,000 per year. To be clear, I'm not spending anywhere near $150,000 a year. I don't even make $150,000 a year for these music productions under one of the tax rules. And for bigger projects, they may be able to write off even more under another rule. So if you spend $120,000 in 2026 to record an album, any of you guys make music? Anybody in here? Hey, thanks, IGN Bar, who says he loves my channel. I appreciate you. I appreciate you joining me. I appreciate the heart. Please let me know if you make music, because I'm a big fan of independent artists. A qualified sound okay, so that seems pretty self-explanatory. Independent, so the benefits go to independent music producers, record labels. Okay, record labels are big business. And artists who spend money to professionally record music. Could include recording studios, engineers, or managers backing sound recording projects. So music production costs can now, they used to have no tax break, and now they can be written off immediately. Annual deduction limit didn't used to exist. Deadline to qualify didn't used to exist. Now it's up to $150,000 per year. Moving on. Section 11, let me leave it on the screen here, 111109. Modifications to low-income housing credit. So under the current law, to receive the low-income housing credit, a building must either receive a credit allocation from the State Housing Financial Authority or be bond financed for the credit. Congress sets the per capita allocation amount on a yearly basis. For 2023, each state received a $2.75 per capita allocation for projects that are bond financed. At least 50% of the aggregate basis of the building and land must be financed with bonds that are subject to a state's private activity bond volume cap. Those were a bunch of words I didn't understand once they were all put together. So we will run this through AI and have it explain it to me like I'm stupid. Additionally, projects can receive a basis boost if they are in difficult development areas. Generally, DDAs are areas with poverty rates of 25% or more, or where 50% of households have income below 60% of the area median income. This provision makes 3 changes to the LIHTC program. First, for calendar years 2026 through 2029, the 9% LIHTC is restored to its 2021 level with a 12.5% allocation increase. Second, for the 4% LIHTC, this provision lowers the bond financing threshold to 25% for projects financed by bonds with an issue date before 2030. And lastly, this provision designates Indian and rural areas as DDAs. So it sounds good if we're including more areas, right? In helping like more lower income areas, more traditionally lower income areas, I should say. You know, obviously there are rural areas that are like big farming towns and things that probably bring in a lot of money. So this is about a tax credit program that encourages people to build affordable housing for low-income families. I'll be honest, I didn't get that when I was reading it, but that sounds good. It's called the Low-Income Housing Tax Credit, and it helps pay for new apartments or homes that low-income people can actually afford to live in. Developers get these tax credits if they agree to keep rents low for people with low incomes. So it encourages landlords to keep their prices low or even lower their prices. In certain areas, of course. To get the credit, a developer must either apply through their state for an allocation or finance half the project with special bonds made for lower income, things like this. Only so much credit is available each year based on the state's population, about $2.75 per person in 2023. Some projects get a bonus boost or more credit if they're built in poor areas called difficult development areas. Under the new provision, it makes 3 changes to help build more affordable housing. It restores the full 9% credit for developers from 2026 to 2029. This gives states more credit to give out, so more projects can be built. It lowers the 4% bond financing requirement from 50% to 25%, which means it's easier and cheaper to qualify for the 4% credit. More projects will qualify, especially smaller ones, and automatically gives bonus points to projects in rural and Native American areas by classing them as DDAs. This helps bring more affordable housing to places that often get ignored. This is good. This sounds good. But I could be missing something. Is this more beneficial for the wealthy or non-wealthy? What do you guys think? Do you guys think that'll help the wealthy? It seems to encourage the wealthy to spend money in less wealthy areas, which I think is good. This is more beneficial for the non-wealthy, the people who need affordable housing the most. So non-wealthy renters are the biggest winners here. The program helps create more affordable housing they can actually live in. Rent is kept low on purpose, and housing is reserved for people with lower incomes. Especially helps rural communities and Native American areas, which are now guaranteed extra support. Developers and investors, which are the wealthier, they get a tax break for building these houses, but in return, they must agree to keep their rents low, house lower income tenants, and do this for years. So they profit, but only if they build housing for low income people, which is good for the low income people. You know, there's nothing that can just automatically be good for lower income people, right? The money can't just come from nowhere. It needs to come from the wealthy. So this, along with a number of provisions that we've read through so far, seem to be about encouraging the wealthy to not give money to the poor, but to spend their money on things that benefit the less wealthy. So it's a big help to non-wealthy renters. It's a big help to developers and investors who are helping non-wealthy renters. And it is no help at all to wealthy homeowners. Love that. We love that, guys. Encouraging the wealthy to spend money on things that help the needy is a great way to do this, in my opinion. Black Sheep, what are you talking about? Live streaming? I guess, yeah, I can use this. I don't know what you're saying. We need more low-income hair. Boy, whew. Scratch that. We need more low-income housing in my area, which is Pennsylvania. I've heard people call certain areas of Pennsylvania. That's very funny. All right, moving on. Section 111110. Increased gross receipts threshold for small manufacturing businesses. Under the current law, in general, taxpayers with average annual gross receipts below $25 million over the prior 3 taxable years are permitted to use the cash method of accounting, are exempt from the cap on business interest deductibility, are exempt from the requirements to account for inventories, and are exempt from certain capitalization rules. The $25 million threshold is indexed for inflation and, in 2025, currently, is $31 million. This provision increases the gross receipt threshold described above for manufacturing taxpayers from $25 million to $80 million. This change applies to taxable years beginning after December 2025, so next year. The $80 million threshold is indexed for inflation and in 2026 will be approximately $100 million. To qualify as a manufacturing taxpayer, a business generally must derive substantially all of its gross receipts from the lease, rental, license, sale, exchange, or other disposition of tangible personal property produced or manufactured by the business. This one sounds like it only helps wealthy business owners, but I can always be wrong, right? You can always be wrong. Black Sheep says, I would have thought that the part before sounds like I can use it for my sounds and lighting company. I think you can. I think you're exactly who that's meant to benefit. Okay, so this is a tax rule that gives small businesses a simpler way to handle their taxes and avoid certain limits and requirements, but only if they make less than a certain amount of money each year. Oh. So it doesn't help businesses who make over $25 million a year. It helps businesses who make under $25 million a year. The money limit is called a gross receipt threshold, basically how much money the business takes in before its expenses. So under the current rule, if a business makes less than $31 million a year, they get some nice perks. They can use simple cash accounting, only count money when it comes in or goes out. They don't have to track inventory in a complex way. They're exempt from limits on deducting interest on business loans. They don't have to capitalize certain costs over many years. What's changing is for manufacturing businesses only. The money limit jumps from $25 million to $80 million. With inflation, that's about $100 million in 20. So now, larger manufacturers can still get those same perks. Let's say you make and sell custom bicycles. If your business made $29 million a year, you already got the tax perks. But if your business made $85 million a year, you couldn't before. Now you can. So this will help larger businesses. So manufacturers making up to $100 million a year, they get to use simpler tax rules and get more deductions. Does this help the wealthy more? Okay, small manufacturers are benefited by... They already benefited. This doesn't change much for them. Mid-sized manufacturers, they now qualify for simpler taxes and more deductions. Very wealthy companies, still too big to qualify. Non-manufacturers, not part of this. So this rule does help bigger businesses, but it's still capped. And giant corporations don't qualify. It's only for the medium to larger size businesses. Black Sheep, you're a busy man. You're a busy man. You're in here moderating the chat for YouTube. You got some events going on this weekend. Oh, it's Friday, isn't it? I keep forgetting it's Friday. All right, I was really hoping to get to page 30, but I'm going to wrap this up because I got to go live again to watch Donald Trump and Elon Musk talk in a little bit. So this will be the last thing I go over. Section 111111. Global intangible low-taxed income determined without regard to certain income derived from services performed in the Virgin Islands. Under the current law, you know what? I'm going to try to make it to page 30. We're just going to keep going until I get to page 30. Under the current law, the global intangible low-tax income of U.S. shareholders is included in the income of U.S. persons in the years it is earned. That is the income in excess of a 10% deemed income return on qualified businesses' assets. Corporations are then allowed a 50% GILTI deduction so that active income earned offshore is subject to a minimum rate of tax between 10.5% and 13.125%. A corporation that is organized in a territory is generally treated as a foreign corporation for federal tax purposes. Under the new provision, this would exempt certain income earned in the U.S. Virgin Islands from being considered tested income for purposes of certain individuals, so it just excludes businesses that are located in the U.S. Virgin Islands? I feel like that's a tax loophole that's being closed. Is that possible? This is a tax rule that affects certain Americans with money or business overseas, specifically those subject to something called GILTI, which is Global Intangible Low Taxed Income. GILTI is a special tax the U.S. uses to make sure wealthy people or big companies don't hide profits in low-tax countries to avoid paying U.S. taxes. This provision will change. If someone earns income in the U.S. Virgin Islands, this rule says we're not going to count that income when we calculate your GILTI tax. In other words, that money is excluded from the GILTI formula, which means less GILTI tax owed. So if you own a business that makes money in the U.S. Virgin Islands, under the current law, that income might count towards your GILTI tax. Under the new rule, that income wouldn't count, meaning you pay less. So U.S. Virgin Islands income simply won't count. You just don't have to report it. People with offshore income pay less GILTI tax. They just don't get this tax benefit. Who benefits? Mostly wealthy individuals. Okay, this one helps the wealthy. Mostly wealthy individuals are companies with complex international tax setups. So if you have your bank account in the Virgin Islands to, as a loophole for taxes, I thought that this was closing it, but no, this is creating a bigger loophole for those people. This is a benefit for wealthier individuals, not everyday workers. So everyone open up a Virgin Islands savings account because the money that goes in and out of there will not be taxed. I like the effing community, but can we call it the fucking community? That might be too much. People might confuse it. I have a lot of adult film stars follow me, and I think it's because they're looking for fucking news. Okay. Moving on. Page 29. Section 111112, extension and modification of clean fuel production credit. Under the current law, taxpayers may claim a credit for the production of transportation fuel, including aviation fuel, to the extent it meets certain greenhouse gas emission standards. The value of the credit is an applicable amount per gallon multiplied by an emissions factor. The applicable amounts are 20 cents per gallon for transportation fuel that is not sustainable aviation fuel, and 35 cents per gallon for sustainable aviation fuel multiplied by 5 if the taxpayer meets prevailing wage and apprenticeship requirements or exemptions. The credit applies for fuel sold before January 1st, 2028. This provision makes certain modifications to the clean fuel production credit. The provision requires the credit is only available to fuel produced from feedstocks produced or grown in the U.S. So this is going to move those tax benefits to only U.S. companies, I think. The provision excludes indirect land use changes for the purposes of life cycle greenhouse gas emissions. The provision extends the credit through December 31st, 2031. It requires the Secretary of the Treasury to establish distinct emission rates for specific manure feedstocks. The provision eliminates transferability for fuel produced after December 31st, 2027. The provision eliminates transferability for fuel produced after December 31st, 2027. Sounded like a repeated sentence, but obviously I just don't understand it that well. This provision restricts access to the credit for certain prohibited foreign entities. Specifically, no credit is allowed for taxable years beginning after enactment if the taxpayer is a specified foreign entity, and no credit is allowed for taxable years that begin 2 years after enactment for a foreign influence entity. Okay, so that sounds fine. I mean, just my knee-jerk reaction is that it isn't really changing much except making it only apply to U.S.-born companies. So under the current law, you get 20 cents per gallon for regular clean fuel and 35 cents per gallon for clean jet fuel. But if you pay fair wages and use apprentices, that credit becomes 5 times larger. You can also sell or transfer the credit to another company, which helps raise money. So, weird. So this will extend the tax credit to the end of 2031 instead of just until 2027. And to qualify, the fuel must come from stuff called feedstocks, like crops, animal waste, or used cooking oil that was grown or produced in the U.S. Fuel made from foreign-grown crops or feedstocks no longer qualify. This excludes indirect land use changes from pollution calculations and makes it easier for some fuels, like corn-based ethanol, to qualify. Okay? I don't think that corn-based ethanol is good for the environment. Let's just ask Google. Is corn-based ethanol bad for the environment? Corn-based ethanol impact on the environment is complex and debated. While some studies suggest it can reduce greenhouse gas emissions compared to gasoline, others indicate it may be more carbon intensive, particularly when considering land use changes and other factors. Okay, so the fuel itself is better greenhouse gas-wise, but the actual creation of it may be more detrimental to our atmosphere. So this will exclude indirect land use changes from pollution calculations. This makes it easier for some fuels like corn-based ethanol. Great. The government must set specific pollution ratings for manure-based fuels. Transferability goes away after 2027. After that, companies can't sell or transfer the credit to others. They must use it themselves. No credit for quote-unquote bad foreign entities. If a company is controlled by certain foreign governments like China, Russia, or other restricted entities, they do not get the tax credit at all. So you own a company that makes sustainable jet fuel from U.S. corn, you follow wage and apprenticeship rules. You get $1.75 per gallon in tax credit. The credit now lasts until 2031, but you can't sell it to someone else after 2027. If your company was owned by a prohibited foreign government, you get nothing. Who benefits? U.S.-based clean fuel producers. That's good. American farmers. Here's who doesn't benefit. Small producers who used to sell credits. They cannot sell their credits anymore. Foreign-owned or controlled companies. No longer applied. This provision is designed to help domestic clean energy, not the wealthy in general, but it does favor U.S.-based businesses over international ones. So if you're a business owner, obviously these things are gonna benefit you more. But more importantly, it seems good. It seems to encourage clean fuel production and U.S.-based clean fuel production, right? And then the people who still continue to make the fuel outside of the U.S., they can still buy and they can still do all the same stuff, but they don't get as much of a tax break, and which means that they will be paying more than the companies that don't, right? And so they'll be bringing in more money, and then it encourages people to move their businesses here and to create clean energy. I actually think that sounds pretty good. Okay, here. All right, we're about to start part 3, which is investing in the health of rural America and Main Street. And I'm gonna save that for tomorrow. We're about to get into like Medicare stuff and emergency hospital stuff. So make sure that you are subscribed on YouTube. Click the bell so you get notifications when I go live. Make sure that you're following me on Instagram, TikTok, all the places. Substack's a really important one. I put a lot of work into Substack, so all these links are in my bio. Support the channel whatever way you want or can. Thank you for joining today's live. I'm going to be going live again very soon at 10:30 a.m. PST. If you are confused, it's currently 10 a.m. PST, 10:06. At 10:30, Trump is going to be doing a press conference with Elon Musk, and I will be watching that live. So come and watch that with me on youtube.com/KellermanComedy. Thank you all for giving